Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This Analyze Out Loud video is going to be on the blue chip Dividend Aristocrat 3M company. As usual, I'm going to start this video by first looking at 3M's adjusted operating earnings over the long run, going back to 1999. The reason I like to do this is I like to see what kind of company it is that I'm looking at or getting ready to research or evaluate. And in the case of 3M, when I'm looking just at earnings alone, a couple of things, jump out at me right away. First of all, the company's earnings growth rate of 9.8% is quite attractive and certainly above average. We have two recessions on this graph, the recession of 2001 and the Great Recession of 2008. During both recessions, a couple of points, the company did see a drop in earnings, 7% in the 2001 recession and 9% in the 2009 recession. This company does have a calendar fiscal year. However, a couple of things. Number one is the company remained profitable during both of those recessions. Otherwise, this is a pretty consistent grower, and it's a AA rated. Company has 47% debt. Currently offers a 2.7% dividend yield, which I consider attractive. My sweet spot I consider 3%, but 2.7% for a company with this kind of growth characteristic to me is attractive. The current PE, however, is a little high, but I'll get into that here in a few moments. So let's just suffice it to say this is a really good company, high quality blue chip that has a really good long-term operating history. So next I want to look at dividends and the dividend payout ratio. This green shaded area, of course, is all the company's earnings. The area below the white line here is the amount of earnings that the company pays out to its shareholders. And of course, on the top is what the company retains. A couple of things strike me about this graph. Number one is you can see very consistent dividend growth. Then we saw a really nice surge in dividend growth in 2014, and we see an actual expansion of the company's dividend payout ratio. So let's go ahead and look at that a little more detail from the performance report. What we see here is that we had very high dividend growth in 2014. The company's dividend went from $2.54 to $3.42, and then they followed that with another very high dividend growth rate. They've had histories in the past where they've increased the dividend at double-digit rates, but generally speaking, this company's been growing the dividend at about 8%. That's the compounded annual growth rate, 7.9. The average growth rate has been 8.2. Last year, they only raised the dividend by 6%. But I also want you to examine the payout ratio here a little bit. In the past, the company was paying out about half their earnings, and they went through a period of time coming out of the Great Recession. You might say they got a little conservative. They dropped their payout ratio into 37-38% range. But now as the recession is becoming the rearview mirror, we start seeing the dividend payout ratio increasing back into the 46 to the 50% range as it currently is. Now the next thing I'm going to do is I'm going to add monthly closing stock prices to this graph, which is the black line, to look at how the market has historically valued this stock. And a couple of things really strike me as I look at this. Number one is we see very chronic high valuations from the beginning of 1999 all the way coming into the Great Recession. Then we see a period of time following the Great Recession, and once again, this was the period where the dividend payout ratio was a little lower than normal. And then we saw the company becoming, let's say, being awarded a premium valuation again by the market. So the next thing I'm going to do is I'm going to add the normal PE ratio, and this calculation is simply what PE ratio has been most common over whatever time frame I'm measuring. Now, what you can see is that on this basis, even though the market likes to put a high premium valuation on the stock, the valuation got pretty excessive coming into 2018. The PE ratio got up to 27. The stock has corrected back to a more normal long-term PE ratio. Now, as I cut time off of this graph, these numbers change. So I think it's important to recognize these create valuation references. The point I want to make here is a research tool like FastGraphs isn't designed to dictate fair value. It's designed to reveal it and allow you to analyze what you're looking at. So, since 2006, the PE ratio was higher, but if you look at it from 2015 on, the PE ratio was actually even higher yet. So as I shorten the graph, now I go back into a PE ratio, a normal PE ratio of 21. And on that basis, 3M would have fallen into fair value. Now I can calculate the drop, if you will, in 2018. It's averaged over 22%, 22.4% since January 31st. Now that's a precipitous drop, but as I said in the title of the article, it didn't take a crystal ball to see that the company was overvalued, even relative to the high valuations that the market likes to put on this company's stock price based on earnings. However, as I also indicated in the written portion, there's more than one way to skin a cat. What I want to look at next is how the market has valued 3M based on its operating cash flows. And as I indicated, this is a very profound correlation here. You can see that stock price tracked operating cash flows at about a 15 PE, and even priced operating cash flow was 14.6. You can see the blue line is just barely below the orange line, which is a PE of 15. And the blue line would be a PE of 14.6. So this to me was an obvious level of overvaluation and unprecedented when you look at this chart. Even at the peak here, we had a priced operating cash flow of 17. At its peak here, we had a priced operating cash flow in excess of 23, and it's very hard to hit it on this such a short time. As there it is, a priced operating cash flow of over 23. That's now down to 17, which is obviously getting a lot closer to fair value. However, I would like to point something out. If I shorten this graph to a shorter time frame so you can see the numbers better, I want you to notice that the company had negative operating cash flow growth in 2017, but is expected to rally quite strongly with over 20% operating cash flow growth for 2018. Of course, keep in mind that that's an estimate. However, we are now over a quarter into this year and the numbers have looked good. So let's take a look at what operating cash flows have looked like for the last couple quarters. In order to do that, I'm going to go into fund graphs or financial underlying numbers. I'm going to go into the company's cash flow statement and look at operating cash flows per share here. And here you can see, a very significant or very steady growth in operating cash flow. But let's look at the last couple of quarters. Operating cash flow growth for 3M for the quarter ended in March of 2018. Of course, the most recent quarter hasn't been reported yet, was actually quite low relative to their historical norms. However, my cursory or just preliminary research indicates that the company did have an $897 million settlement that had an impact on their operating cash flow for that quarter, as well as their free cash flow. Now, moving on to the future, let's look at what the analysts are expecting for operating cash flow for the next year. Now, one thing about this, you'll see a lot of earnings reports. The company lowered guidance in their most recent earnings report. However, the fast graphs are reflecting the guidance that the company has recently guided lower. But notwithstanding that, operating cash flow is expected to recover, and I think a significant portion of that is because you aren't going to have the legal settlement impacting operating cash flow like you did before. So on an operating cash flow basis, the company looks very attractive at this point. Now, if I look at the normal priced operating cash flow of about 15.9 over the last 5 years, it looks moderately overvalued. If I choose a longer term operating cash flow like the 7-year normal, it still looks a little pricey. In other words, the normal priced operating cash flow has been about 14.6, you remember from my previous iteration. So as I indicated in the summary of the written portion of this article, I don't consider 3M cheap today, but it's certainly a lot cheaper than it was at the beginning of the year. Priced operating cash flow was over 24 in January of 2018. So the company has gone through a significant correction. The question is it going to correct more or not? If I owned the stock, as I said, I wouldn't be selling it here. But on the other hand, I'm not sure I'd be a purchaser of 3M at this price, even though it's an impeccably high quality company. Looking a little deeper under the hood, I'm going to look at gross and net profit margin, the red and dark blue line. You can see a very high level of consistency here. Gross profit margins have been in the 47 to 49 range. Net profit margins have been in the double digit, I'll call it mid double digit, 13, 14, 15% range. And then returns on invested capital have also been pretty consistent, averaging about 21% in previous years. Coming out of the recession, it dropped down to about 17%. But it now looks like it's actually increasing back into the 19 to 20% range again, return on invested capital. So the company did go through some issues in the recession, but they were minor. The company was still very profitable. It looks like it's doing extremely well right now. But again, the bottom line is I would rate this company a hold at these levels. But I'd like to close this by talking a little bit about dividend coverage. Here I'm looking at free cash flow. I'm not really too concerned about the price to free cash flow. I'm really looking at the dividend to free cash flow. And the company generates ample free cash flow to continue covering their dividend. So I'm I feel very secure that their dividend is safe and will continue to grow as it has in the past. Nevertheless, I would like to end this video by looking at a couple other valuation metrics. For example, I'm going to add year-end dividend yields on the graph here. And what I want you to see here is that this is year-end 2017. That dividend yield was 2%. It's now 2.7%, which is closer to what we have here. Here's 2.5 when the stock was trading at its normal PE ratio. But again, valuing this stock by operating cash flow, I think, is the most sensible way to look at it. When the price got really cheap in the throes of the recession, you're able to buy it at a dividend yield of 3.5%. But otherwise, this is a company whose dividend yield has been in the 2% range, 2.5% range most of the time. It's currently available at 2.7%. It has a market cap of $116 billion. And I think this could be one that you want to keep watching. If it gets a little cheaper, it might be worth considering adding to portfolios, especially for those looking for some growth and capital appreciation along the way. The long-term historical performance of this company relative to the S&P 500 has been stellar. I want you to notice it generated almost 3 times what the S&P 500 did in dividends, but it also generated more than twice as much capital appreciation over the long run. And that's a testament to the fact that this company does grow an above average rate over time, or at least has historically grown at above average rate over time. Looking forward, it's expected to continue to grow at 10%. The 3 to 5 year trend line growth, again, around 9.5 to 10%. So if you could buy this stock a little cheaper, and again, I would value it looking at operating cash flows, you might want to take a closer look at 3M or keep your eye on it. This has been Chuck Carnevale saying thanks for watching.